Hey, good morning, everyone. Marty Mazzora here, Friday, 6th of October, 2023, with your weekly economic update, the second video to hit your inbox today. Clients in particular really want to encourage you to take in the earlier one. If you had to choose one, make it that one, although I think this one's going to be interesting and somewhat telling as well. But in my earlier video, I went into unusual detail on a few things that I want you to take in when you have a few minutes. As for today's economic report, I want to start a little differently first and just kind of speak to the market reaction this morning. I shot the earlier video yesterday evening, and I suggested that I was expecting a soft jobs number today and consequently potentially a rally in stocks. Well, the jobs numbers I'll explore here in a minute came in crazy hot relative to expectations. It was double what expectations were and 100,000 more than the most aggressive economist had in terms of expectation for job creation. And then, of course, the market rolled over pretty hard, about 1% on the S&P, over 1% on the NASDAQ, in the pre-market and into the beginning of the trading as well. Even in the cash session, stocks were down. Now, I said in my written intro to this morning's blog, there was actually some softness, and it was in the wage data, and that's really what you want to look at for inflationary purposes. And what I didn't mention, though, that I explored as I got into more detail, was the household survey, which is a survey of consumers, and that's where they get the unemployment rate. That only came up with like an 86,000 new jobs number, as opposed to the 300 and something from the BLS survey. So that was a soft reading as well. Now, what I suggested in the written intro to my earlier morning blog was that once the market digests the softness in the report, maybe it'll mitigate some of the losses that we were seeing. And I found it interesting that gold was in the green already. Gold in particular. Silver was up a bunch as well, while the dollar was up like 0.5%, which is a big move for the dollar. So what I suggested there is that maybe the precious metals traders are sniffing out some of this softness. Now, as I speak, and we're 2 hours from the close, S&P is up 1.2% and the NASDAQ is up 1.5%. So clearly, if all you had were the employment numbers, the market looked through to softer details and is trading up on prospect for a softening economy going forward, which frankly, beyond the knee-jerk, short-term reactions to all that, that's not the right narrative to be buying stocks under it. As I continue to express here, in videos and on the written blog. And one place that I go to just kind of get just a quick explanation for what might be happening is Bloomberg's Market Live blog, where all their analysts hop on and give opinions during the day. And it was interesting to see the one that popped up right here. U.S. stocks were bolstered in morning trading by the largest buy imbalances since mid-July, and short cover. Momentum can beget more upside momentum in stocks. What they call the tick index printed its high of the day at 11:40 New York time. It represents the number of NYSE securities trading on an uptick minus those trading on a downtick. It can often signal algorithmic activity. With the index trading up, it may indicate program buying, and I think unequivocally it does. Traders concurred, saying a 3 sigma run-up in a short time span triggered tactical buy signals in E-mini S&P 500 futures. Programs in either direction can often create momentum in the same direction. So absolutely, you'll get, particularly when you had such bearishness. Remember I said on Monday, and then I said again yesterday, that sentiment has flipped to bearish. So if you get any kind of catalyst and maybe just program buying, people are going to freak out and they're going to suffer that FOMO, that fear of missing out. And I saw some serious oomph. So, we kind of wanted to set you up for expectations of somewhat of an October rally that is really more of a, I think, yet another bear market rally when we think about the fundamentals and the broader macro setup. But, of course, we'll take it when it comes, but it's good to expect these things, and it's good to understand why. The other thing that I think we cannot emphasize enough, and this is more under the surface stuff, is the volume of options trading that's going on, both in a speculative way and in a hedging manner. And the dealers, the people who provide the supply of these options, are really on the hook in big market moves. So if the market begins to move against them, they have to, in the case of upside risk, they have to jump in and buy the underlying security. It's not because they're bullish, it's because they have to protect their exposure. Some of that, I suspect, is going on today as well. So understand that, particularly during bear markets, you get these big upside moves. Often it's just a positioning is one-sided, people get surprised, and boom, they go rushing to the other side. That clearly, I think, explains more than anything else what happens today. Next week, we're going to get the minutes from the Fed meeting. That may not be all that market friendly, but we're also getting the latest consumer price index, inflation data. Base effects are supportive of higher inflation, but for the most part, the trend has been softening. I don't know what the number is going to be, but if it comes in soft, that also is something that we can anticipate would be good for stocks, particularly when a big cohort of investors have already moved to the bear side of the boat. So folks, I guess in a nutshell, just expect more volatility in both directions as the latter part of this cycle continues to shake itself out. Okay, so quickly with regard to the economic update, we actually had a nice pop, a 6-point pop in our PWA index to negative 21.3, which was, again, a nice improvement. Still quite a ways below what we would consider a score that says odds favor expansion going forward. So our recession signal is still flashing a pretty bright red at this point. In terms of the inputs that I wanted to share with you this week, starting with auto sales, still nothing to write home about, but auto sales did improve on a month-on-month basis. Mortgage applications, on the other hand, continue to decline. We are now breaking below that range that took us all the way back to the mid-90s. Again, with where mortgage rates are currently, this should come as no surprise, particularly in an overall kind of weakening macro environment as well. As for the jobs data, as I mentioned, non-farm payrolls came in really, really hot, right? We had, like 170,000 was the expectation, 160 or 170. We end up with 336,000 new jobs. Unemployment rate stayed right where it was. Average hourly earnings, this is what I talked about earlier, on a year-over-year basis to 4.2%, on a month-on-month basis, 0.2%. And then we also got this week the job openings and labor turnover report, the so-called JOLTS report. The quits rate, which is part of that, stayed at 2.3%. Higher the quits rate, the more optimistic people are about the economy. And then job openings actually ticked up to 9.6 million. That was a surprise to everybody. That played havoc with the stock market because it was positive economic news. Labor force participation rate stayed at 62.8, and the U6 unemployment rate, which includes discouraged workers, dropped a little bit from 7.1 to 7.0. As for where the jobs came from, and by the way, the prior 2 months were upped by 119,000. Those are revisions. All of that increase came from government jobs, that 119,000. As for the private sector, we actually had downward revisions that totaled 12,000. As for this print, the September number, 73,000 jobs came from government, mostly at the state level. Private sector added 263,000. And again, the household survey was pretty weak. So nevertheless, really good, strong jobs number. Clearly, it jolted the markets right off the bat, maybe for an hour or two. And then as it was all digested, for whatever reasons, program buy orders stepped in and off to the races, to the upside, at least for the moment. Institute for Supply Management, both the manufacturing and services surveys were out this week. Manufacturing looks to perhaps have bottomed. Now, 49 is still contracting, but at a slower pace than previously. Services, on the other hand, rolling over just a little bit, but still solidly in expansion territory. Clearly, people are still spending money on services. There's a lot in those reports. If, as I go through them, if there's information there that I think is worth sharing with you on the blog, could have to do with employment prospects, what they're seeing in terms of inflation, growth, and so on. The global PMIs, Purchasing Managers Indexes, ticked down to 50.5 from 50.6. Below 50 is contraction. So the aggregate done by JP Morgan, still net growth in the global economy, but moving in the wrong direction. I thought we'd take a quick look at commodities. They've been rolling over pretty hard with stocks of late. And again, that would be a sign of a weakening economy. They're up pretty nicely, I think mostly across the board this morning. Oil is in that. Oil is down like 10% this week. So the Bloomberg Commodity Index is still not down to the yearly lows, but of late we've seen quite the rollover there. Of course, in the grand scheme of things, that would be disinflationary as well. Copper price really taking quite the hit here as well. Despite somewhat better economic news out of China here of late, although this is a daily chart, so we did get that uptick here. But again, copper dropping below the 2023 low would be a bearish economic sign. That would be positive if you're looking for inflation to calm down, which we are, because we think the economy will be slowing. You could argue that there's a falling wedge pattern there, so we'll do a technical analysis on that on another day. Baltic Dry Index is really defying what we're seeing in those commodities, particularly in copper. It is just skyrocketing straight up. So this is the cost of shipping goods across the world's oceans. And that going up suggests that there's a great deal of demand for that shipping. And so that would be a positive sign relative to the global economy. So definition of a mixed picture, but still on a net basis, overall, still a very recessionary look across our economic indicators. Folks, I will leave it there. Hope you have a wonderful weekend. Thanks for watching. Bye-bye.